Yeah. Uh, Siddharth, Ritesh, am I audible?
Yes, Vishal, you are.
Yes. So, good evening to all of you. I think by now you guys would be very familiar with couple of us from here. We have been regular appearances on most of our webinar, and if you have been following us, what we have tried to do specifically since the start of the war, although that's a very sad thing, but we have tried to frequently keep all of you guys updated with what is happening towards the investment universe. And the situation is very fluid and dynamic. And today, what we have got is a broad panel. With me, we have Siddharth Srivastav, who heads the ETF product, is manager of a lot of global funds that are being managed, also looks at solution based offerings, specifically equity allocator, multi-factor, etc. Then Ritesh Patel, of course, doesn't need any introduction. He has been the backbone towards the commodity gold and silver, the solution oriented towards gold and silver. And of course, I'm your host, Vishal Singh. So I think we'll start. There are already 109 participants. So what we would like to do is we'll keep it more 35 minutes an update for you guys, what has happened, pick thoughts and the brains of the people who are here, and then maybe take a Q&A. So before we jump in and start, Siddharth, why don't you give us a brief update? What has been happening in the market, right? We are seeing Nifty 22,950, 23,700. Where is the low?
Yeah, thank you. Thank you, Vishal. And like we always do, whenever we are doing alpha beta webinar, we basically talk about all the indices and tell how different segments have performed. Uh, Till last month, we have always been talking about the fact that earnings recovery is going to be the key for markets this year, especially, and there was some signs that earnings recovery is happening, and we were obviously being more uh, uh, confident about the markets going forward. The only question was whether the momentum which will come back in the market, will it be will it happen just in next 1 2 quarters, or will it take a bit longish time? But all that conversation has changed because of what has happened in Middle East. And I'll do, I'll just briefly summarize what has taken place in the market. uh, and then I know most of you are joining for gold and silver. So I'll just give a very brief update, and then I'll invite Ritesh to basically talk about gold and silver in bit more detail. So in this conversation about the markets, I'll just keep it interactive with Vishal, and then we'll move to gold and silver. So please do hang on, because I know that people are more interested in commodities these days, even more so than equity markets right now. So yeah, so equity markets, as we all know, have been very choppy, have corrected significantly in last few weeks since the entire Middle East crisis started going on. Basically now, your Nifty, which is Nifty 50, is roughly around 12% down from its 52-week high. We have already seen a correction of 11.5% this YTD. Even when we are looking at mid cap and small cap, they have also corrected on similar level. In fact, surprisingly, mid cap 150 is only down 9.1% compared to 11.5% of Nifty 50, and small cap is also 11.3%. So both mid cap and small cap have actually fallen less than Nifty 50. Mid cap by almost 2%, have fallen less by more than 2%, and small cap have fallen less by almost, let's say, 20 basis point on a YTD basis. When it comes to what has happened on the sectoral offerings, we can see that there is a broad market uh, correction across sectoral indices. So you can see double digit corrections, low double digit corrections in financial services, in bank, PSU bank, private bank in last 1 month, all of them down from 11 to 12%. So their FS broadly, including PSU and private, all of them have fallen. Oil and gas is down almost 10%. Also, what is down is autos at around 12% because of the concerns on performance due to rising fuel cost. Uh, Apart from that, also, if you're looking at sectoral indices, you can see that FMCG is down 9%, IT is down almost 9.7%. Talking about last 1 month, your PSU is down around 7%, manufacturing is down around 7%. So, all in all, most of the indices, banking is down 11 to 12%, but other sectors are also down almost 9% or so. YTD also, if you look, you'll see that banking is roughly down around 10%, and your consumption, FMCG, etc., are down around 10% plus. The major correction has happened in IT, which is down 23%. So, what I'm trying to say is that this bloodbath which has taken place in last a few weeks is pretty much across board, apart from some insulated segments like pharma and utilities and power as of now. So these have been stable in last 1 month period, though they are just marginally positive. And if you're looking at other segments, I've already covered it. Now, especially from if you look from a PE point of view, because that that has been one of the conversations where PE is now, because of this correction, we are looking at relatively attractive valuations, at least on the large cap side. Your Nifty 50 PE is just 18, uh, compared to 10-year average of 19.7. Your mid cap PE is also now below its 10-year average. Your small cap is premium, but that premium is also narrowed, 24.4 versus 23.5 of last 3 years. So, broad market, your large cap has reasonably gone down below its 10-year average valuation. Mid cap is marginally below its 10-year valuation, and small cap is now marginally above its 3-year average valuations. If you are looking across other segments, now you're finding from a valuation point of view, banks, PSU banks, private banks, attractive segments becoming more and more. In fact, a while back, we were concerned about how expensive even, let's say, metals are looking at and energy is looking at, but there also some valuation contraction has taken place. Now, what we are essentially saying, and we'll cover it in next slide also, that where you should invest. Uh, and before we talk from a product to product point, this just highlights that right now, if you want to invest, uh, we have a multi-cap product which is there in the offering, which is Nifty 500 multi-cap 50 25 25. Because there's a broad market correction taking place, there's no sector which significantly stands out in terms of opportunity in last because of last 3 weeks correction. I think if people have money and wants to invest at these levels, I will suggest the multi-cap investment, especially on the ETF side, which is Nifty 500 multi-cap 50 25 25. It invests 50% large cap, 25 in small, and 25% in mid. On the index fund side, you can look at our total market cap offering. The only reason that is that I see a broad market correction, and rather than picking and choosing which segment to be in, it's better to have this participation in a broader product. Because like I said, that even Nifty's large caps are down by 10% or so. So why to pick a segment which is just down 11 12% when your large cap is down 10%, right? So that is one suggestion which we have. We'll discuss more when we go ahead and talk about products. Any comments from your side, Vishal, you want to highlight which I have missed in terms of how markets have behaved in different sectors and themes across market cap segments in last 3 weeks especially.
Uh, I think, Siddharth, broadly what you have covered is where I also quintessentially agree with. But that said, for a lot of investors who are still slightly, afraid about the volatility, etc., I personally feel that Nifty itself is when it is down by almost 12 to 13%, as you have highlighted here in charts from its all-time high, 52 weeks. It can be probably a good bet to start off with rather than taking maybe higher exposure to small mid. But Siddharth, where I think it's very important right now, there are only two possible scenarios, right? That war probably ends relatively soon, which is what market is consenting about. And then you are looking at probably earnings and markets getting repricing. And the another scenario is the war stretches for period long enough to sufficiently keep crude at an elevated level that you have a supply side shock, inflation. Combining this, let's say if you have 100 rupees to allocate for your multi-cap even, how much would you deploy right now? Because your market is almost 14-15% from its all-time low. As I said, I mean, there is almost a 50% probability to either scenario, but for somebody investor who has been waiting, I mean, your subsequent slides, I think they will cover it into, but largely now Nifty was expensive compared to Chinese, but now it's almost on the level of emerging markets. So where do you see in terms of deployment of money getting into? And secondly, I think although this slide of yours doesn't cover, how do you think defense as a sector is getting re-rated across the market?
So, Vishal, it's very difficult to predict what is going to happen geopolitically. Sadly, we are in those times where uh, what has been the typical convention in international politics in terms of any conflict resolution is has been thrown out of the window. So you very rightly said that we don't know when this conflict will get resolved, right? It is actually it is escalating every second day. So it's a wishful thinking to not be aware and not be mindful that this can go on for a very long time, or probably it can get rectified and resolved in 1 week. Also, we remember how quickly that 12-day war got uh, over, or conflict got over last year when Israel and US attacked Iran. So, and if this prolongs, I think there have been enough market commentary. If this goes on for one more month, we will start to see significant impact on economy and the corporate earning projections also, right? All these PEs we are talking about have been projected pre-war or pre-conflict, right? All these crude oil or inflation input cost will go high. There'll be supply chain disruptions if this war continues, and because of that the earning projections will go down, and because of earning projection going down, automatically the PE will go up, and from that point it will start again at these levels. Market may suddenly start looking expensive also, right? If Because PE is a combination of pricing as well as projected earnings, because we are looking at 12-month forward projected earnings. So all that can happen. Yeah, and that is why I'll my personal preference will be not to pick a sector right now, because it is very difficult to to take that sector call right now, because nothing is standing out in terms of corrections which has taken place, and opportunity is so huge that you cannot avoid it. So I think what I'll do is I'll probably allocate, if I have 100 rupees and I have to invest in domestic markets, I'll invest, I think, around 50% right now in multi cap only, and then keep 50% with me, and then see how to go about. Because if I remember last year when we were talking about corrections, we were all excited that if market goes down to 22,000, 23,000, that is a good entry point. I think along with time correction at 18 PE, markets are looking attractive. But like I mentioned, that probably will go staggered, probably invest 40-50% right now around 23,000, and then see how it goes, right? So that is all on this particular slide. What I'll do is let's bring in Ritesh in this discussion. So I'll simply talk about, and this we have been highlighting. So we had this monthly webinar where we talked about, and where debt team, fund management from debt team, from active equity team also sits, and there we talked about the fact that typically people look at gold and silver as uh, as as an asset class which will work when geopolitical risk is high, when war is going on, especially gold, right? Because gold has been associated with as a safe haven asset, and it typically works when and goes up when there is a very significant high risk scenario evolving, which is right now. Your markets are correcting. Your crude oil has shot up significantly. There are, if war sustains, you don't know that crude oil at 150 can become a reality, right? Even that conversation is held right now. You are looking at natural gas, etc., also getting impacted and being at a very high cost. So why is gold not performing? So before I bring in Ritesh, I like to obviously tell the audience that if we go back to this particular slide, you will see, and this is March 20th ending data, you will see that even post correction, what gold has corrected, you're still seeing gold giving 60% plus return, right? And you're still seeing silver at 130% plus return. So while it is down by 40% from its all time high, silver is still up by 134% in 1 year. And while it is 16% down from its all-time high in gold, it is still up by 67% in last 1 year. So what is also happening is that in these scenarios, when markets are correcting, all the asset classes are correcting. In case of margin calls, in case of necessities, it seems that people are doing profit booking in gold and silver. See what has happened in gold, and then we'll talk about silver also, is that in last 1.5 year, you have seen lot of financial investments happening in gold, right? Apart from your central bank investment, I think last year 800 ton plus was invested by people like us only, who are at times shorter in horizon when you compare them to central bank holding, right? Even in silver, a lot of speculative trading has taken place, a lot of investments have happened. So the holding period, if I can say, of such people are on the lower side, and we see profit booking happening, and that is why gold, which went up from 5,100 to 5,300, is now around 4,700. It went down to 4,650 last night. Similarly, silver, where we were always cautious, has is now hovering around $70. It went down to, I think, $68 last night. I think right now it was around 73, $74. So what I'll say is that every asset class is also a function of how much it has run up, right? I'll try to take an example of a plot in Navi Mumbai before airport was going to get announced. And when airport get announced, the price of that plot shot up, and you had significant earnings from that plot. Now, after the Atal Setu came, and after other highways uh, got made there with broadened and etc., the price of that plot then further didn't go up significantly, right? A lot of people did profit booking. A lot of people Obviously the rate of that particular plot was already higher. Same thing happened in gold also. Gold, apart from central bank buying because of geopolitical issues, was already up, and now we are seeing people doing profit booking and all these things happening. But I'll not take the entire time. We have Ritesh. So Ritesh, why don't you come in? And Ritesh is commodity analyst and fund manager at Mira Asset. Vishal has already introduced, but let's listen to Ritesh in terms of from a technical point of view, and from a on a short term basis, where are you seeing both gold and silver? And from a long term point of view, if people want to invest, let's say for 1 year, 3 year, how are you seeing gold right now? So, do you want me to show this chart, Ritesh?
Yeah, it's okay.
Yeah.
So, Siddharth, you have picked up correctly that in the past we had seen gold performing when there is a geopolitical issues are there. Okay, but right now the scenario has completely changed. Gold is not performing, silver is not performing, and we could see that. And yes, you have rightly said that why they have not performed, because in the prior to just this war, gold and silver has already delivered a good amount of returns. Okay, so that is the reason that at this moment when people are expecting gold and silver to go up, rather they are removing their, in fact, they are booking their profit at these levels, and they are waiting for some correction into these commodities and re-enter it. And if you have seen that always gold, silver and the dollar index have a negative correlation. So if you could see that dollar index have recently made a low of 96 or 95 odd. Okay, from there on it has gone up to $100. So it is suggesting that a dollar index is becoming strong, and that is the alternate reason why gold and silver are not moving up. Okay, so they both have a negative correlation in the past. And going ahead also, if you could see that currently also, if you could have noticed that whenever dollar index goes up, gold and silver goes down. Okay, so that is one of the reason why gold and silver is not performing at this moment. But coming to your question, uh, uh, currently, if you could see this chart, gold is currently near its support level, which is at 4600, 4650. Okay, once it goes below that level, then the next support would be at 4460. Okay, so these are the two levels where one could accumulate gold from these levels. While on the higher side, if you could see at this moment, if you look at the current price, the risk reward is quite favorable for the investors. Okay, from these levels, we could suggest that investors should enter, or if they already have, then they could also start looking at entering into these levels for the higher side. On the higher side, we could expect that somewhere around 5000 to 5200 levels from 1 year to 3 years time horizon. And for silver, if you could
Yeah.
change the slide. Yeah. Yeah. And for silver, we were expecting that silver should, if
So
silver,
Ritesh, I'll stop you here a bit. So because let's be a bit more clear when you're talking about gold. And Vishal, you are more than welcome to jump in this conversation. So basically, what we are saying is that gold has corrected. One of the main reason why gold corrected was because of profit booking, which is apparently taking place because gold ran up so much. Still, it is 67% plus from a 1 year return for, right? We're talking about margins being satisfied by selling gold, etc. There's also a fact that, like you mentioned, that gold is negatively correlated with dollar is doing well. You're also seeing yield spike happening, and all those are in a way negative
negative.
for gold prices as well as silver prices as well. So these are the three reasons. But yeah, prominently is because we feel that profit booking is taking place. We were, in a way, to be honest, comfortable with gold prices around 48, 4900 also. But what you are saying, and just for everyone's, that even current support level at around 46, 40 is interesting. and next support level is at 4460, around $4,400, let's say $4,500. So people can look at buying gold right now. So if you want to enter gold, even 4600 levels seems very attractive. While earlier we were talking about staggered buying for gold also, at these levels you can start evaluating, let's say, a lump sum investment, or investment at dips, etc. So if you have 100 rupees you want to allocate in gold, I think, Ritesh, probably people can invest majority of that portion at these levels, right? And
Correct,
and
correct.
probably keep some amount for any further corrections, because
Correct.
at these level
Because
gold are
in the
looking
past,
nice.
yeah,
Yeah.
because in the past you had seen that gold has probably reversed two times from these levels. And this would be the third time where gold prices are moving up from this level. So this would be the good level to, get into this commodity if anybody has missed the rally, previous
Okay.
rally.
Okay. So yeah, uh basically we are in a way, at these levels at 4600. uh we are obviously turning sorts of bullish on gold, that you can invest in gold even in a lump sum manner right now. At 4400 we'll start finding it a bit more attractive. So if you have, let's say, 100 rupees, you can deploy around, let's say, 60 70 at these levels. 100 rupees for gold, then 60 70 at these levels, in gold. And in terms of future projections, I mean, we were pretty comfortable with around, let's say, 5500, 5100 a while back, and that is the retractment we are looking at, Ritesh, in near term, right?
Right.
Okay, okay. Now let's move to silver. So silver has obviously, what I like to highlight before Ritesh, we involve Ritesh, talking about levels, etc. Uh, Gold is more of a safe haven. It has a lot of central bank buying, institutions buying. Yes, a lot of investments have also happened by people like us, which has made gold volatile in terms of profit booking, etc. Silver is a bit more peculiar compared to gold, because it has huge industrial usage. So while in risky scenarios gold does well, at elevated geopolitical risk gold does well, in war scenario typically gold does well. In silver, what will also come in strongly is growth, global growth, because it's an industrial asset also, right? We all know that silver is used in photovoltaic cells and EVs, etc. And if there's a very negative impact on global growth because of all these issues, you may see silver correcting more or being more risky, because any downside revision in terms of growth, in terms of uh, and war continuing for a long time is negative silver. So compared to gold, where we are finding 4600 levels attractive right now, silver we are probably a bit more cautious, because of the negative uh, effects which it can have on silver, because of world economy slowing down. Yeah, it's over to you, Ritesh. Now, if you can talk about silver
Okay.
also from technical point of view and from fundamental point of view.
Yeah. So as of now, we had already seen silver correcting from say $90, say 2 weeks back to $72 where it is currently. So, but one thing to note here is that prices are taking U-turn after testing $70 level. Okay. So this is the third time or fourth time I can say that prices are testing $70. Once it goes below $70, then we may see silver prices to, move towards $60. So the gap over here is quite big as compared to gold. So, as Siddharth has said that we are more cautious in silver than gold, and we are waiting for silver to either rebound from here or break down. If it breaks down from here, then we'll probably wait for the silver to come around $60, and then we'll increase our allocation in silver. While from here, if it rebounds and gives us some positive confirmation, then we'll probably do the same in silver prices. Uh, I think the chart. Okay. So apart from that, if apart from war thing, if you look at the fundamentals, there has been no change in any fundamental for gold and silver. The central banks are buying for gold, ETFs are buying, and speculative demands are always there. So once we see gold and silver prices to reach to their reasonable level, we believe that from there buying would definitely come going ahead. So just wait for some correction in both the metals, and from there we could see some more upside coming into the prices. And why we are more positive in gold and why not silver is that the gold silver ratio, which is indicate. Now what is gold and silver ratio? Gold silver ratio is basically indicates that which commodity is outperforming in the current scenario. Okay, so we had seen that in the past 3 to 6 months back, where that ratio is around 108 108, that has come down to 40. What does that mean? That whenever gold outperforms silver, that ratio goes up. Okay, so when the ratio went up to 108, at that time gold was outperforming, and we had seen the run up in silver last year. So in that time we had seen that silver has outperformed gold, and that is the reason where the ratio has gone down from 108 to 44, and currently it is around, say, 65. And if we see the long term average, that is at 87, or we get, if I take the 10-year average, then it is at 87 to 90. So there's still some room left for gold to outperform silver. So that is why we are more positive, or more, we could say, inclined towards gold than silver. And the
Sure.
points which Siddharth has also mentioned.
Sure, sure. I think there's some technical glitch as always. So what we'll do is, Ritesh, by the time Siddharth joins us, there have been a lot of questions on gold and silver. Let's just see, assess what the investors, their thinkings are towards specifically gold and silver. So what I'll do is, I think you have answered, but we'll just take quickly some of those ones. The first one and foremost is, which comes it, can it go to 4,300? I think Ritesh already covered it about I first support. Ritesh, correct me if I am wrong. The first support is around 4,600, which Ritesh conveyed. If it falls below that, it is 4,400. But with the looking at the charts and etc., he believes trend in the reversal more likely than on the downside. Ritesh, anything you would like to say when the investor is looking at 4,300? I think it would be fair to say, Ritesh, if your crude prices continue to cross 120, 140, and the war goes on, your real yields are going up, then probably your gold, you are looking at even your second support level being breached.
Correct, correct. But 4,000, there's no much gap between 4,400 to 4,300. That maybe intraday spike, it may go to 4,300, but not necessarily. But I feel that the long-term support is around 4,400. It should not breach ideally.
Sure. I think there's a question from Manish who talks about US-Iran war having a negative impact on gold prices. I think Manish, Siddharth, and Ritesh already alluded to it. See, largely, all this war scenario, long term, if anything, it has strengthened more, the allocation towards a precious metal, whether it is gold or silver. It has taught that countries need to probably diversify from crude, move to renewable, which gives a long-term incentive. But Siddharth rightly pointed out at the start, what you're seeing is short-term correction. I think for last couple of webinars that we have been hosting, we have been very vocal about that your gold and silver are expected to be in a consolidation phase, range-bound manner. And this is largely because market's current priority is liquidity. Liquidity is to fund their margin, to fund the crude, to fund the dollar, and that's the reason why you are not looking at the immediate spike in the prices of gold and silver. But if there is anything, this war, as and when it ends, the long-term case for making an allocation to gold and silver, both, it makes more strengthen. And with that, Siddharth is back. So I think, Siddharth, we have very well covered. I think Ritesh has already talked about gold and silver. Why don't you update us towards what is happening towards bit on the international market, specifically
Yeah.
the US economy, the Brent prices, how much they are up? I think they are more than 50% up. So just give a quick update and then we can look at the domestic earnings and chip in Ritesh where needed.
Sure. Sure. I think before I move towards international markets, just one last question from Ritesh, and pardon me, Ritesh, if you already covered it. I think network was bad. So if we look at let's say 25-year average, and I hope you can see the slide. Average of gold silver ratio, it is around 68. If you're looking at 10-year average of gold silver ratio, it is around 81. Right now, when we are looking at gold silver ratio, it's around 64. Right, and there's a time when gold silver ratio went above 100. Gold became so expensive, and then we saw a crazy rally in silver in last 6 month, in last quarter of last year. So my question is that yes, gold has corrected. It has gone down to 4600, 4700. We are now turning a bit more bullish on gold. We are suggesting even lump sum investment right now. Silver, we are still a bit more cautious on. I think you must have said about that silver. There is an it can go down to $60 also, is what your next round of resistance is at. I'm asking that we are running a gold silver fund where we invest in both gold and silver, and their decision becomes more tricky because we have to choose not only obviously to invest in these commodities, but allocation also. So uh, what is the gold silver allocation right now, and do you think you will continue with that allocation?
See, as war goes on, we feel that gold should benefit more even if it reverses even if both the commodity reverses from here. So we are more inclined towards gold as of now than silver. So the current allocation is 65% in gold and 35% in silver. So
Okay.
even if we see a big fall in silver prices, there we will add some money into it. But as of now, if you ask me, then what is your preferred metal? Then I would probably say gold than silver,
Okay, so probably silver needs to fall below 60,
or
for
around 60.
or around 60 for us to probably look at increasing allocation to 40% plus in silver. Till
Right.
then, we are comfortable in the range of 35% to 40%, right?
Correct.
At
Correct.
these levels. Great. So obviously we'll bring in Ritesh back whenever there are more questions. If there are more questions of gold and silver, which I'm pretty sure there will be. So let me quickly cover other aspects. And first, now I'll talk about international markets as well. Surprisingly, I think that and Vishal, you can also pitch in, is that US markets have fallen the least if you compare it to Asian economies, which just highlights that how much dependent we are on Middle East in terms of uh, fossil fuels. I was reading that even China have a significant strategic reserve of crude oil. It has reduced its dependency on Middle East significantly in terms of oil procurement. Yes, they have continued with the Russian procurement, and also we know that overall, from an energy consumption point of view, China is one of the largest, I guess, solar power users, and using other avenues also in terms of power. So now looking at US market, it's hardly down. Nasdaq is down just 2.6% in last 1 month, 3.4% in just on this YTD. We were down to 3.25% just yesterday. FANG is in fact a bit positive on 1 month. YTD it is down 8.2%. We all remember that that is because of concern around very high spending from FANG companies on AI data centers, etc. We are talking about commitment in, I think, in north of $600 billion or so, and probably start of these companies like Google using leverage to fund these investments. So that was a concern which has obviously uh, made FANG correct a bit more. And at the start of the year, we talked about the fact that there will be some rotation where FANG will, in a way, underperform, and you will see more performance coming from non-tech companies or S&P 500 equal weight or so. And when you look at S&P 500, it's just down 4.3% last 1 month, 3.2% on a YTD basis. China also has corrected in last 1 month, though not as much as India. Like I mentioned, that they have a more diversified basket. 6.4% Hang Seng Tech is down. Hang Seng is down 4%, and MSCI China is down 4.5% in last 1 month period. So again, from an investment point of view, like I've been saying, that you can continue to look at China from a tactical point of view. Looks numbers which have recently come out in terms of consumption, sales, exports, etc., a bit more positive than what market expected. Yes, Chinese government have revised their GDP expectation to 4.5 to 5% this year, which is one of the lowest in recent history. But but I think from a valuation point of view, etc., China still can be a good tactical play. Uh, and when it comes to US market, we continue to be positive on themes like AI and AI data center. So any uh, dip there should be used for the for accumulation. Very quickly, I'll move towards US economy. Uh, uh, Fed policy just came out this week, and they have they have shown concern around war, that it makes things a bit more uncertain. It seems like that Fed will only cut once this year, so their Fed rate probably will be only cut once this year and once next year. In fact, now the market conversation is also that there won't be any cuts this year. It all depends how long this war goes on. So whatever I have said till now will change if war continues for 1 more month. And if when we do webinar and war is still going on, probably you'll start seeing me more pessimist about a lot of things. And it's very that's why I'm saying that situation is very fluid, and stick to probably multi-cap allocation right now at dips rather than taking sectoral calls. US in terms of again policy has came out. Unemployment numbers were bad last month. But apart from that, I think when you're looking at growth and corporate earnings, things look okay. Again, all that conversation will change if we continue to see escalations and crude again on a sustained basis being above $100, $120 or so. Uh, Again, from won't spend much time on US economy, because like I mentioned, that in terms of while job data and when we are looking at job numbers, they were already starting to look some worrisome in last month or so. But again, the conversation will change when we are uh, depending on when the conflict escalation happens or it subsides. In terms of CPI, while Fed is rightly concerned, we are now looking at your core CPI, etc., uh, just above 2% or so, which looks okay from US economy point of view. So simply again on China, we are looking at a bit more when we're looking at Feb data, we are seeing some recovery in terms of domestic consumption, sales, etc. A lot of that has also been driven by Lunar New Year spending in these holiday festive seasons. So that was bit positive. Exports have continued to remain positive. Like mentioned, external sectors have remained positive on that front. And like I mentioned, that sales, consumption, in fact, inflation also has come a bit on the upside. So fear of uh, deflation, etc., has in a way subsided in Chinese economy also. Now, more concern remains on the fact that are we going to see Chinese growth going forward being more and more normalized to around 5% and below. Uh, so let me just quickly again present our product basket. So we have recently launched healthcare, energy, uh, uh, infrastructures, defense, etc. But like I mentioned, that if you want me to pick one fund right now, I'll pick out Nifty 500 Multicap 50 25 25 uh, ETF, which participates in the entire universe, 500 universe, and 50% was large cap, 25% was mid and small cap. And like I mentioned, that now that gold and silver has fallen, I look buying into gold and silver for fund of fund, which is the asset allocator,
Siddharth,
which we have.
sorry to jump in, but what you talked about multi-cap approach, could you also highlight about that fund equity allocator specifically at this point in time for the investors? What you rightly pointed out, probably sectorial call from 10-year point of view, you can look at defense, etc. But for the immediate, for the ETF perspective, there is a multi-cap solution that you talked about, which does 50, 25, 25.
Yeah.
Equity allocator, where are we in terms of allocation? You are the fund manager. Where you're looking at in terms of broad allocation, and how does it fit vis-a-vis, let's say, somebody investing in Nifty 50 index?
Yeah, so basically, equity allocator is a very low cost allocation fund which we runs, where our objective is to have this placed as compared to large cap funds. So we typically allocate 20% plus minus 5% or so in mid cap. We have roughly around 65% plus minus 7% in mid cap, and remaining is next 50. So we look at earnings, we look at where we are looking at from valuation attractiveness, and then we allocate uh, in these three ETFs only: Nifty 50, Next 50, and Midcap 150. Nifty 50, we are roughly around 63, 64% around benchmark allocation. Next 50, we are around 1%, 2% higher, around 15, 16%, and we are 20% in Midcap. It's a very good fund. The overall cost is, I'm talking from a costing point of view, um, because overall cost, including the cost of underlying, is just 10 basis point. So if you want to participate in just large and mid cap in a passive manner, equity allocator is a preferred product. If you want to participate in a more risky manner across large, mid, and small, where 50% is large, 25% mid, 25% small, then multi-cap is the product. If you want to invest in index fund, which participates in large, mid, small, micro cap category, then total market cap index fund is something which you can prefer. There's 70%, I think around 60, 65%. 65% will be large cap, and around 20% mid cap, 10% small cap, around 3-4% micro cap in terms of weightages. So yeah, so you can look at these spreads. What we have, I hope we have covered most of them. Um so we can now, Vishal, move to Q&A, because I think we have already spoken for almost 40-45 minutes.
Sure.
Before that, I would just like to highlight that we have missed one point for gold and silver, that as Siddharth has rightly pointed out, that Fed is now expecting to do a rate cut just once in 2026, but prior to this they were expecting a rate cut more than two or three. So whenever there's a rate cut happening in US, gold goes up. So when the expectation has reduced, prices are also moving down.
Sure. Thank you for the update, Ritesh and Siddharth. And I think right now it's high time we take the Q&As. We have more than 24, 25 open Q&As. And of course, no surprises. A lot of them are revolving around uh, gold and silver. So we have taken a couple of them. I think I'll start with Ritesh. Over to you. This talks about the ongoing war tension. If it continues, more oil price rising. Further, Russia has been a seller of its gold reserve in order to support Russia-Ukraine war. Poland has announced its plan to monetize its gold reserve to support oil prices. So you see, the investors who are coming here to ask questions, they are reading what is happening on the World Gold Council reports. So Jan 2026 saw a sharp decline in gold purchase. I think Ritesh should be fair to correct, but I think it was moderately reduction, but still there was net positive buying compared to gold purchase by central bank in year 2025. So effectively, what Mr. Manish is trying to say is, with all these scenarios, isn't it time to be cautious on gold?
So as we have said that whenever in the past what we had seen that whenever these war kind of a situation is there, gold goes up. Okay, so we have already seen the implication of what reasons you have mentioned. We have already seen gold prices correcting from their highs. So if it comes around the reasonable level, there is no point that gold should not go up. If this war continues for a longer period, people would people would move towards the safe haven asset, and that is gold. So I believe that if this war continues for a longer period, we might see some positive impact in gold going ahead.
Sure. Thank you, Ritesh. I think Siddharth, this is where I would want you. I have been asking you to always recommend where are you allocating money. So for a long-term investor who wants to do in gold and silver, should they do SIP or lump sum, or how are you allocating right now? Ritesh already talked about support at 4,400. It's
Yeah, yeah,
already down
yeah,
for
yeah. So,
5,200.
so
So where are you
because of,
seeing it?
see, I think there is no straightforward answer because both the commodities are moving 5 to 10% on a daily basis. Having said that, if gold is around 4,600 and silver is around 70, that is my base assumption. I'll go ahead and deploy around, if I have 100 rupees for gold and silver, I'll go ahead and deploy, let's say, 60 rupees right now and do a, let's say, STP of remaining 40 rupees for next 3 to 6 months.
Sure.
Or if you are keen follower of the market, you yourself can obviously track the dips, and like I mentioned, that further correction, especially in silver, you can allocate it yourself or do the STP. I think out of 100, I'll go almost 60%, 65% in lump sum right now in gold silver.
Sure. I think I'll take a question of an equity. An investor is asking specifically for a India new age consumption. Should they go for lump sum now, Siddharth? It's already down 15-20% from its all-time peak. Auto, consumer discretionary. I think we all like that segment. Consumer
Yeah, yeah.
discretionary, structural theme. Where do you see it?
It's a, again, market has gone down further at 23,000 plus. Now we are talking about. I think the reality that the war can continue for some more time continues to exist. I think my answer will be similar to gold and silver. That if you have that is a beautiful fund that taps into discretionary spending. Again, purchasing at dips is something which is the best thing. I think this is a very good investment time. But point is that, is this the low, or if war continues for 2 3 more months, I think we can see much more adverse impact. So I think out of 100 rupees, if I have and I want to invest in new age consumption, or I think anything right now, probably 50 60% is what I'll go right now and hold it for remaining 30 rupees, 30 40 rupees, invested in bit more staggered manner.
Sure. I think Ritesh, investors is asking what are the current allocation of gold and silver in gold silver passive fund of fund. Also, can you just highlight the structure of its journey? I think from the August 2025, how the allocation has shifted, the calls that you have made.
Okay, so as of now, the allocation is, as I've already mentioned previously, the current allocation is 65 in gold, 65% in gold and 35% in silver. When we launched this fund, at that time we were inclined towards silver. At that time, we were having some 55 to 57% in silver and remaining in gold. Later on, when the rally happened, we were already inclined, or we were overweight in silver. But later on, when the supply crunch came, we were not able to procure silver. So because of that, we went down to say 40-45% in silver. And after that, we were expecting some correction in silver prices, so we have reduced the allocation. And in say November to December, we have reduced it to some odd 45 to 50% in silver prices, so silver, and remaining in gold. We have also kept some cash. We have also taken some cash call. We were having some 3% to 3.5% in cash when the fall happened.
Yeah, I think what Ritesh is alluding to, it's just a marginal cash that has been left up to maximum 5%. I think not more than that. Thank you, Ritesh, for that. Apart from that, I think Siddharth, this is an interesting question because some investors are very, still not aware that on one side we say gold and silver both are hedged during inflation and turbulent market situation. At other side, we say it industrial metal linked to CapEx cycle. How can this be true for silver? I think Siddharth, where I would like you to really takes, maybe more than 2 minutes, 3 minutes. Investors are not being able to comprehend the fact they were anticipating the gold and silver prices to skyrocket at the onset of war as soon as probably a missile was launched, but that has not happened. Why the immediate trigger and why the long-term outlook, if anything, it makes more robust for the precious metal.
Yeah, so I think, see, we need to ask ourselves only, right? If I have investments in multiple asset classes, multiple funds. If I need to take money right now, will I take out of my equity holdings funds which are down 10, 15, 20%, or will I take out of gold and silver or gold which are up 70% or 80% in last 1 year itself? Just ask yourself, right? And typically anyone will feel that equity, if war, let's say, gets over in next 2 3 days, then there's a significant recovery which can happen in equity also, right? We have seen that external disturbances, if they dissipates, then there can be a sharp recovery. So people are, I'll be banking on that, and I'll be making redemptions out of my gold and silver holding. I think that is what is happening. There are a lot of positions which were built into both gold and silver. Like I mentioned that last year, uh, 800 tons of gold were purchased. For 2 calendar years before that, there was no positive net flow only. There was an outflow, right? So you are looking at significant positions being built in gold and significant positions being built in silver also. We can just look at what is happening in India, right? The highest traded ETF at times is silver ETFs only, and not even gold. So, I think what has happened is that simply that because it ran so much, we were from $27 to $120, even $70 is a significant return for someone who invested at $30. So, I think profit booking is something which is happening right now. And I think if you ask yourself where you will book the profit, you will get the same answer. So I think, yes, from a theory point of view, gold should have gone more, silver in a way should have gone more, and then if war continues, sh- uh, is expected to correct because of let's say reduction in GDP growth, etc. But the entire ball game changed because it was already at a at a very high premium. I think again, like I took a very bad example of real estate. Just think from that point of view only, that if that a location can have a very, let's say, very high rates for plots and flats. It's a premium location. If a highway comes there or an airport comes nearby, the incremental value is typically not does not add compared to a position if you have a flat at a place where rates are lower and it's not that popular locality. The incremental impact on the rates will be much higher. So you also have to look at the value at which asset classes right now, and then assess all these impact. It is probably happening for the first time that gold and silver has gone up so much and war immediately happened. So people are surprised, but more you think about it, more you realize that I think probably we should have expected it. And like I said, that we expected for silver more so, to be honest. At these levels, at 4600, and if we go down to 4400, we'll again like turn a bit more positive on gold.
Sure. Thank you, Siddharth. Because you have kept this international and commodity performance slide, I'll just take quickly questions pertaining to this. While I do understand that we are not accepting the money, but this is, I think, from the investor who has already invested. He is asking about AI tech, and as you can see, YTD it's only 4% down, where your Nifty is 11% down, Nasdaq, S&P 6.7% down. AIQ fund that Myriad launched, what should they do with their holding? And second question, on the international, somebody is asking, uh, what is the update on international funds ETF? Are there any which are available at a par or discount to INAV?
So I'll take the first question first. I think international artificial intelligence and tech has done really well. If you look at 3-year data, etc., I think Vishal is pointing out that it's almost like 30% up even after this recent correction. It's a global tech portfolio. 70% is US, 30% is non-US, captures China, Japanese, Korean companies. So it's a NASDAQ 100 at a global level. So I continue to remain positive, like I mentioned, on AI and tech, uh, simply because going forward, and if you look at the companies, it's not just software companies like Google. It also has hardware companies, semiconductor companies, you have data centers, you have cloud computing companies. So it has the entire ecosystem, and very bullish on that ecosystem from next 3 to 5 year point of view. Yes, valuation can be discussed upon, but see, these are a set of companies which are going to change how world functions. So I think like Fang, uh, I'm positive on artificial intelligence and tech. If you ask me between the two, I'm more positive on artificial intelligence and tech because it is a bit more diversified in terms of exposure. Because in FANG you have 10% exposure to each. In artificial intelligence, it is a capped index, and also you have exposure to all these non-US companies, including Chinese companies as well. So positive on that. As far as the second question is, our ETFs will continue to remain closed because we don't have a room left to open these products for subscription. That's why trading at significant premium. About there are other funds, index funds of funds which are open right now. You can probably explore that. What is trading at premium or not, I think it will depend on a day-to-day basis for other providers also. You can look at INAV and then take that decision.
Sure. I think thank you, Siddharth, for that update. And quickly for the investors who are very interested in the AIQ fund, we have an outbound fund, correct me, Siddharth, that has an allocation to the Global X Artificial Intelligence ETF. Ritesh, bringing you here in, I think there's a question, when do you see 90 USD level back in silver? So what I'll do is I'll just modify that question. I think there has been swinging around 10%. It can go tomorrow also for silver specifically. Where is the resistance place for silver right now specifically? Resistance 1, resistance 2, and just looking at the market, right? Because for last, specifically after 29 Jan, there has been a lot of corrections. You have seen, you have been on the desk 6-7% swings in the international MCX circuit getting hit, MCX getting, the trades are getting halted. So, firstly, where is the resistance, and do you think it's, at least I don't, I think Siddharth will agree, it's not right to look at and try to time 90 entry. What's your consensus about the silver specifically?
See, coming to the original question, where when it will uh, touch $90, that nobody can predict. But yeah, I can say that this is the at $70. If it reverses from here, we could see silver to be in a positive territory, and we could see that the recent correction that has happened from let's say January to March, that could be considered as a correction zone only. Okay, but once it goes below $70, then the whole scenario may change. We may see more $10 correction, and we could see silver to even touch $60, as I have mentioned in my commentary. So it is just about how prices are reacting from here. If it reverses from here, then we could see some positive move, and if it falls from here, then $60 would be the ideal level where one could look at. But buying at lower levels would be highly suggested, as the risk reward becomes favorable for any investor rather than entering at the higher levels.
Sure. Thank you, Ritesh. So what Ritesh is trying to see, rather than trying to estimate and assess where 90 is going to be there, nobody knows what is going to be the low. But as you said, right now it is 70, it go 55, 68. Siddharth alluded to it. There have been a lot of questions, Siddharth and Ritesh, about allocating to gold and silver specifically, whether it is lump sum, whether it is, staggered. I think both of you are of a consensus view that I think maybe you could look at 30-40% lump sum and then stagger it over 8 to 12 weeks where you are looking. So that's a lot of gold and silver. I think there's a question, Siddharth. What is your view on next 50? I think this is a very interesting question, Siddharth, because next always in conversation about Nifty, mid cap, small cap, there is this very beautiful index next 50 that is a large cap, but the behavior risk reward profile is more mid cap, sometimes more small cap, where you're looking at. And I think also it's very important to allude, for last 1 year, calendar year 2025 was a bad year for next 50, right? So are you looking a mean reversion specifically in next 50? What's your consensus view? You already talked, you have a certain allocation to equity allocator. Where do you see it?
Vishal, I'll answer and probably I'll ask you to also add to it. See, next 50, the portfolio, the only concerns, the only concern which is there is some of the PSU names ran up quite a lot within the next 50 index, and that has made index a bit more challenging from let's say from suggesting an entry at these levels also. So, if you ask me right now, what is my preferred index will be, I'll probably pick out Midcap 150. Uh, Bit more preferred than Nifty Next 50. I think your answer might be a bit different. So my order of priority will be obviously Midcap 150 first, and then probably looking at if you're looking for a short duration, then if you're okay with the long duration, then Next 50 and then Nifty 50.
Sure, Siddharth. I think, to be very honest, I would also prefer equity allocator, as it gives me a combined allocation of 10 to 15% to next and balance to 10 to 15, 20 to mid. So it takes that two-third, one-third approach very beautifully. And sticking to equity allocator, there has been a question from the investor. He talks about that what is the track record for the fund. I think, Siddharth, it's been 5 years live track record for the fund, if I'm not wrong. Can you just briefly allude how it has done? And I think, would it be fair to make an apple to apple comparison with the actively managed large cap? Because this is what the scheme tries to do, mimic beautifully and create. So just quickly, maybe in two, three lines, where the performance for the equity allocator is. If I'm not wrong, then it has been almost, correct me, Siddharth, almost 1.5, 1.6% 5 year alpha over Nifty 50 with a similar volatility, right?
Yeah. So it is, I think, very I think comparison with large cap funds is very relevant, and the entire idea behind launching equity allocator was to give a large cap replacement at a low cost in a fund of fund wrapper. It is taxed. LTCG and STC is similar to uh, for normal mutual fund scheme. It is for fund of fund also. So in large cap active funds, fund managers are allowed to buy up till 20% in non-large cap category, right? And similarly, we are also having allocation of around 20% in mid cap. So what we typically do is we look at entire large and mid cap universe. We look at where the free float market cap based weightages will play. So typically, if you look out of large and mid cap, Nifty 50 captures around 65%, next 50 captures around 14%, mid cap captures around 20-21%. And then what we do is we typically, our range is around plus minus 10% of these weights. So Nifty 50 will go plus minus 6.5% as of now. Next 50, let's say plus minus 1.42%, and so is mid cap around plus minus 3-4%. That is what we do in a range bound manner. Like I mentioned, that's only 10 basis point of cost for a direct plan, including the underlying. And it has done really relatively well. If you look at historical, we have been there since 5 years. If you look consistently in 5 year, 3 year, 2 year, 1 year, you will see this fund being in typically in quartile two. Right. It outperforms 70% of funds on a pretty consistent basis, but it will be there in quartile too. In bad times also, ज़्यादा गिरेगा नहीं, good times also बहुत ज़्यादा बढ़ेगा नहीं. So we try to generate that marginal alpha so that you are there in Q2. So and that's why we are seeing that now the AUM is around 1,000 crores for this particular product, simply because it does that so beautifully. It does not take extreme calls. It does a range bound allocation based on valuations. Is a low cost product, and like I mentioned, it's not a Q1 product. It will not be, let's say, a best performing large cap fund. Hopefully it will never be a hopefully it will not be a worst performing. It will lie somewhere around Q2, or borderline Q1 Q2, or Q2 Q3. So that's the intent, and it is being doing fairly well since its launch, and people obviously can visit our website and look at its track record.
Thank you, Siddharth. I think Ritesh, this one is to you. There is this question specifically coming in. How should one rebalance gold and silver holding over time when they are doing DIY? Any other specific strategy that you think would make it more tax efficient? I think why don't you, Ritesh, talked about the gold and silver fund of fund, why it is relatively more tax efficient for investors than doing at a DIY level.
See, when you do DIY, you attract taxes whenever you buy or sell the ETFs. Okay, but when you go with the gold and silver fund as a mutual fund, we have a tax pass through. We don't attract any tax whenever we buy or sell, or we interchange the we increase the allocation from gold or to silver. Whenever we interchange, we don't attract taxes. So that's the main benefit of going through fund of fund route. So that is the main benefit of having that rather than doing DIY. So that is what the question was, or is there
Fair,
anything?
fair. I think what Ritesh is trying to say, trying to convey is, see, it all depends upon your belief in your own ability. If you can time the market, if you think you can do DIY bet a lot better, then you don't need a solution. But more often than not, you'll probably fail in answering when to time, how to time, and can you do it in a tax efficient manner. You'll end up attracting marginal tax rate at a slab rate. Continuing to this, I think this is a very interesting question, Ritesh, because this Pankaj has asked that. Uh, Most FOFs now have at least 40 to 45% allocation in their portfolio to silver. I think he's talking about gold, silver, fund of fund in the market. Most of them are sitting around 40 to 45. Should be lower to around. I think you are sitting at a 35 percent, and you already alluded to it. Again, just to confirmation, Ritesh talked about Mirae right now hovering between 65%, roughly around gold, 35% to silver. So this is where we are sitting in. I think Siddharth, what's your view on metal ETF fund of fund? An investor has asked.
Uh, Again, see, metal is very cyclical. It is very much correlated on how well the economy is doing. Like have been mentioned by us, and obviously it's fairly well known, if war continues for significant amount of time, there can be a negative impact on economy. And so as of now, if you are asking for investment right now, I'll probably look at, अगर आपको metals में invest करना है, I'll do it in a staggered manner. I won't go lump sum. And if you're looking for buying right now, like I mentioned, that I'll probably prefer multi cap, because right now it's situation is too fluid, and we are not sure, obviously, of this event, how long it will go, to be very comfortable with investment in metal as of now.
Sure. Thank you, Siddharth. I think that's all. Most of these questions are revolving around few ones which we have taken. There's this one question which talks about any best to Mire index or ETF to invest, looking for honest advice. I think Siddharth always, I mean, he gives a very honest and genuine advice. I think he already talked about, alluded to multi-cap, but see, any of us cannot give an exact answer specific without knowing your risk profile, correct, Siddharth? Without knowing your ability and willingness. But in terms of a broad allocation, Siddharth talked about multi-cap, I think being one. Any other one, Siddharth? He talks about two, he needs two names.
No, again, like I mean, see, I also like theme and sectoral investment. It's just that from a risk reward point of view, nothing has corrected so much that I start liking it to suggest it. So इसीलिए multi cap is something which I like right now, because like I mentioned, participates in the entire market fall. But if your risk appetite is lower, a bit lower, you can look at, let's say, a total market cap index fund or an equity allocator fund of fund. So risk profile के नाम पे most risky will be multi cap 50 25 25, then will be total market cap because उसमें almost 70% large cap है, and then will be your equity allocator, which is, like I mentioned, almost 80% large cap. So that's how you can look at it.
Sure, Siddharth. I think I'll take just last question from Krishna, which talks about, do you think investing in an index-based fund is better at this time for a long term rather than directly investing in a large, mid, or small cap fund? I think, Siddharth, I'll only answer this. Krishna, see, I think it's not about active and passive. See, for an, let's say for from among large, mid, small, there are more than 25 funds, right, available. And Siddharth, please pitch in to correct me if you think, what I'm saying is incorrect. There are more than 25 funds. Now, which fund do you want to select? First, you'll have to do a due diligence. First, you have to analyze the track record, look at the performance commentary, and then pick two or three funds. Now, what is happening? Markets are being so reactive. You are looking Nifty fluctuating between 22,900 to 23,900 within a week. Now, at this point in time, you don't have a time to react and check, go do the due diligence of which funds to invest, which active funds to invest. So, for this point in time, what you know is that if Nifty has fallen, you buy either Nifty ETF or you look at Nifty index fund options. And for your long term portfolio, you can have a blend of both large, mid, small cap. Do your due diligence, select the fund manager that you like, his style of investing that you believe works very well for your portfolio. But the caveat is, right now the markets are so fluctuating that you don't have this time to do a due diligence on a 1 day basis. You will need at least 2 weeks to conduct the due diligence to finalize the fund manager and then start your SIP, right? At this point in time, why the index investing makes sense from the allocation point of view, tactical one, incremental allocation, whether it is lump sum 40%, what Siddharth talked about, 50, 60%, whatever it is. This is where it gets easier to do, and rather than saying pick this versus that, correct, Siddharth?
Absolutely, absolutely. I think every fund manager has a very different style, and that's why you'll see that in this dip also some active funds have fallen much more than the other. So if you want to participate in this, in market correction, I think ETFs and index funds, ETFs obviously, because you get to have that intraday levels. I think that's a very best thing about ETFs, otherwise index funds.
Sure. I think just last, what exactly, Siddharth, is a staggered manner? Whenever we say staggered, and what is the duration of staggering?
So typically staggered investing, right now we are talking about it because we don't know what's the length of this conflict, right? And we don't know that, and longer this drags on, the greater impact it is going to have on our economy, on corporate earnings, etc. And that is going to linger on in terms of market performance also. So rather than investing at one point in time, because you are unsure that you may get better entries because of corrections, etc., and this event can carry on for let's say weeks, you stagger your investment for a period of, let's say, 2 to 3 months, or 2 months or so, and invest, spread your, if you have 100 rupees, you can invest, let's say, 40 50 rupees right now, and for 50 rupees you can invest over a period of, let's say, 10 weeks. And that is what is staggered investing is, because nobody can time the market perfectly at all times. So hence the staggered investing is typically used for neutralizing this, and spreading out your investments, so that you get a hopefully a better averaged out NAV of your investment.
Sure. I think, thank you, Siddharth. Thank you, Ritesh. Thank you for all the investors. We have had a broad, more than 90 minutes discussion, but for the good or bad, how the situation evolves, this may or may not hold true, whatever we have tried to communicate. I think most of us would agree. So thank you all. This session is recorded, available on the YouTube. Please do reach out to our all social media handles in case of any question, queries. Tag us along. We'll be more than happy to answer. And hopefully, when we see you next time with the Alpha Beta webinar review monthly, probably the scenarios are relatively more better, and Siddharth, Ritesh could come up with more sectorial, thematic, more lump sum investments rather than staggering. So thank you all. Please have a good weekend. Thank you.
Thank you.
Thank you.